Today, we will talk about bullet bonds, their structure, and how they compare to amortizing bonds. A bullet bond is a debt investment that pays the entire principal amount in one lump sum on the maturity date, instead of spreading out the payments over time. These bonds are non-callable, meaning they cannot be redeemed early by the issuer. Bullet bonds issued by stable governments usually have low interest rates due to low risk of default. Corporate bullet bonds may have higher interest rates, attributed to credit ratings and risk. Corporations and governments issue bullet bonds with various maturities, and a portfolio consisting of bullet bonds is termed a bullet portfolio. Issuing a bullet bond is considered riskier for the issuer than an amortizing bond, as the entire amount must be repaid on a single date. New market entrants or those with lower credit ratings may find it easier to attract investors with an amortizing bond rather than a bullet bond. Bullet bonds are generally more expensive for investors to buy compared to callable bonds, as they are protected against bond calls when the interest rates fall. Bullet bonds differ from amortizing bonds in their payment structure. Amortizing bonds are repaid in regular installments that include both interest and part of the principal amount, ultimately repaying the loan in full at its maturity date. On the other hand, bullet bonds may require small, interest-only payments or no payments at all, until the maturity date, when the entire loan plus remaining accrued interest must be repaid. Pricing a bullet bond is calculated by determining the total payments for each period and then discounting to a present value. For example, a bond with a par value of $1,000, a yield of 5%, and a coupon rate of 3% that pays the coupon twice per year over a period of 5 years, the present value would be $912.48, which is the price of the bond. Here are 3 key takeaways. 1. A bullet bond is a non-callable bond in which the principal is repaid as a lump sum when the bond matures. 2. Both governments and corporations issue bullet bonds in a variety of maturities. 3. The issuer of a bullet bond accepts the risk that interest rates during the life of the bond will decrease, rendering its rate of return relatively costly. Hope this would help. Thanks for watching.